Artificial intelligence is often described as a productivity technology, but its deeper impact is not simply about productivity. It is about the shape of cost. For more than a century, industrial competition followed a familiar rule. The more a company produced, the cheaper each additional unit became. Factories spread their fixed investments across growing output. Labor became more efficient with repetition. Procurement improved with scale. Distribution networks expanded. The result was a predictable economic pattern. Average cost declined as production increased. This downward movement shaped how industries expanded, how firms competed, and how markets priced goods. Artificial intelligence begins to change that pattern, not because cost disappears, and not because production becomes free. Instead, the cost curve itself begins to change shape. It bends less, and in some systems it begins to flatten. That sounds like a technical shift, but the consequences are economic. When cost curves flatten, scale advantages appear earlier. Supply expands faster, prices face stronger pressure, and competition begins to move away from operational efficiency and toward capital absorption. This is not a story about cheaper software. It is a story about what happens when cost stops behaving the way markets expect. In traditional industries, costs usually accumulate alongside production. Factories expand gradually. Equipment is installed in stages. Labor grows with demand. Costs move with output. As firms produce more, they spread fixed investments across a larger production base. This produces the familiar downward slope of the industrial cost curve. Artificial intelligence reorganizes where cost appears in that process. In many AI systems, the largest expenditures occur before production even begins. Models must be trained. Data must be collected, prepared, and structured. Infrastructure must be built to run systems reliably. Engineering teams must design the architecture that holds the system together. These are not small operating expenses. They are front-loaded capital commitments. The system absorbs economic weight early. Once that weight has already been absorbed, output can expand without requiring the same proportional increase in cost. This is where the structure begins to shift. A trained model can produce thousands of outputs, sometimes millions. Documents, predictions, recommendations, decisions. Each output still requires compute, but the incremental cost of generating the next unit is often very small compared with the cost required to build the system in the first place. Costs fall sharply early in the life of the system. Then they stabilize. The curve stops falling the way traditional industrial curves do. Instead of gradually declining with scale, it reaches a plateau much sooner. This is cost curve flattening. Production is not free, but once infrastructure exists, additional output does not dramatically change the economic burden of the system. This structural change alters how scale advantages appear in markets. In older industrial environments, firms gained advantage through gradual efficiency improvements. They optimized production, reduced waste, improved logistics, and slowly pushed their cost structure downward. Flattened cost curves operate differently. Once infrastructure has been deployed, the key advantage becomes the ability to absorb that infrastructure cost across a large base of activity. Large firms can distribute those costs across many workflows, products, or customers. Smaller firms often face similar foundational investments without the same scale over which to distribute them. The result is not simply a difference in efficiency, it becomes a difference in economic geometry. Two companies may operate similar technology, but their economic positions may be very different depending on how widely they can distribute the initial capital burden. This is why artificial intelligence often strengthens scale asymmetry. The system rewards the ability to absorb early cost and extend its reach across large volumes of activity. This shift introduces a new kind of institutional vulnerability: utilization risk. In the industrial model, if demand dropped, firms could scale back labor and raw materials to protect margins. Costs were elastic, but in a flattened AI cost structure, the infrastructure persists regardless of volume. The servers still depreciate, the energy commitments remain, the engineering burden stays on the balance sheet. Because the capital has already been absorbed, the cost of an idle system is often not much lower than the cost of a busy one. This creates a constant pressure to maintain high utilization. Organizations find themselves pushing volume through the system simply to justify the original investment, even when the economic return on that additional volume begins to decline. Scale is no longer only an advantage, it becomes a requirement. When cost curves flatten, the break-even point does not simply move, it hardens. A firm is either operating at a scale large enough to absorb the infrastructure, or it is being weighed down by it. Another consequence emerges once many competitors begin operating under flattened cost curves. Price competition intensifies. If the marginal cost of producing the next unit becomes low for everyone, markets begin losing one of the traditional forces that supports pricing stability. Supply can expand quickly. Output becomes easier to generate. Competitors can serve additional demand without proportionate cost increases. When supply expands faster than demand, prices tend to move downward. This creates a paradox. Automation reduces production cost, but the same economic structure can also compress margins. The benefit of efficiency does not remain entirely inside the firm. Some of it moves to customers through lower prices. Some of it is competed away between firms operating similar systems. This is why low marginal cost should never be confused with guaranteed profitability. That assumption appears frequently in technology markets. A company sees that producing the next unit is inexpensive and assumes that long-term margin expansion must follow. But if competitors operate under similar cost structures, cost efficiency alone does not protect profitability. Prices begin to compress, customers gain leverage, and the economic surplus created by automation becomes distributed across the market. Flattened cost curves therefore change where competition happens. Instead of competing primarily through production efficiency, firms increasingly compete through position, distribution, customer integration, platform control, access to capital. Once cost structures converge, advantage shifts towards the ability to shape the market rather than simply produce within it. This structural shift also affects how companies invest. In traditional industries, capacity often expands gradually. Factories scale step by step. Additional equipment and labor are added as demand grows. Artificial intelligence infrastructure behaves differently. Firms frequently deploy substantial capital layers before demand is fully proven. They build data pipelines, provision compute infrastructure, train systems, integrate the architecture into workflows. Only after those investments are in place does large-scale production begin. The economic risk therefore moves earlier. The cost curve flattens only after the initial capital burden has already been absorbed. If demand grows, that investment begins to distribute itself across a wide base of activity. If demand does not grow, the infrastructure remains. So flattening can be powerful, but it is not forgiving. Artificial intelligence does not eliminate cost. It reorganizes it. Capital moves earlier in the system. Infrastructure becomes the dominant economic asset. Production becomes less sensitive to volume, and scale becomes a function of capital capacity rather than operational efficiency. In many industries, this gradually transforms how firms think about growth itself. Expansion becomes less about adding incremental capacity and more about extending the reach of an already built system. The cost curve still exists, but it behaves differently. It stops falling in the way industrial systems taught markets to expect. And once that happens, firms are no longer competing inside a familiar economic structure. They are competing inside a new one. That is the business physics of artificial intelligence.